Thank you for joining me. Philip Norton here with Norton Trading. As most of you already know, I routinely put out videos with my technical breakdown of different stocks. However, I found that most traders have very little knowledge of technical analysis. What makes it worse is there's a whole lot of people out there trying to sell you their tutorials on technical trading, which you could probably get for under $20 just by buying Technical Analysis for Dummies on Amazon. Everyone and their mother will tell you that there's a magical indicator that'll make you millions. But that is just BS they're going to tell you to get your hard-earned money, so they don't have to work to get it from the market. I do recommend studying technical analysis, as doing so will help you learn about different chart patterns and how to read certain indicators. This knowledge is important. However, today I'm going to show you how with just the basic understanding of technical analysis you can be successful trading. This lesson is that there are simply 4 things that you must identify before taking a trade. That's right, just 4 pieces of information to know before you trade, and you'll drastically increase your odds of successfully trading. So let's get into it. The first is simple. You want to recognize your chart pattern. Now I use this concept broadly because this could be one of many different things. If you just look at the TNDM daily chart, you will see several of these opportunities. First, we have a gap and go on high volume here on May 14th, with the same breakaway gap concept again on June 22nd. Both instances are very bullish. Next, you have a bounce off the trend line, and finally, you have an island reversal candle here at the very top of this run-up. It is called an island reversal as it has a gap up the day before and a gap down the day following, leaving the candle out on its own little island. As you can see, here are just 4 examples of chart patterns you can easily see. The second is finding your entry point, which really should be thought of as a confirmation point. Some traders like taking the trade right when they recognize the chart pattern, but that is a riskier move and I prefer to enter on confirmation. In almost all cases, confirmation is simply the first candle to make a new high or low in the direction you're anticipating the move. In the first move, we get confirmation the next day with an immediate break of highs. In the second example, we get a pullback of several days before breaking higher. And in the third example, we have confirmation the following day as it breaks the previous high of the day candle that held up the trend line. And in the final example, we get confirmation again the next day as we break the previous low of day. So for all that money people charge to train you on how to technical trade, you're basically just simply recognizing a chart pattern, which you can get in a simple book or just by Googling chart patterns, and then you wait for confirmation of that chart pattern. That's all it takes to enter a trade. However, if you want to be successful, this third piece is the most important. It, unfortunately, is also the most commonly ignored part of trading. That is knowing your exit point. You will never bat 1,000. In fact, most top professional traders are only correct on a trade about 60% of the time. The key is not to always be right. It is to limit your losses. We don't trade to be right, we trade to make money. And you can't make money if you're constantly taking big losses that blow up your account. So this third and most important piece is to identify your exit point. Just as confirmation is almost always the break of a high or low of the previous candle, your exit should be set to the other side of the previous candle. In the first example, we had a buy confirmation the following day, which would put the exit point at the bottom of that previous day's candle. In the second example, though, we had to wait several days for our buy point, but the exit is still the bottom of the previous day's candle after our confirmation. In the third example, we bought as we broke yesterday's high of day on the support of the trend line. As you guessed it by now, the exit is simply the bottom of yesterday's candle. And finally, we had our island reversal pattern, which was confirmed when we broke the low of day from the previous day's candle, which makes the exit point, of course, the top of that previous day's candle. Simple enough, right? You now understand how to enter a trade on confirmation and set your stop loss to limit risk if the chart pattern does not play out. The final piece is important, mainly for psychological reasons. This final piece is position size. One of the biggest reasons traders fail is they panic and sell too soon or hold too long and blow up their account. This happens because they took a trade with a position size that was too large. For example, on the island reversal trade, we know that the entry point is the break of yesterday's low, and the stop loss is the top of the previous day's candle. That means your entry point is around $46 and your stop would be around $48.84, which is almost a $3 risk. So before you take the trade, you need to know how much you're willing to lose comfortably. If your max loss is $300, then you should only be taking 100 shares. If you think that isn't enough shares and you want to take 1,000 shares because your account size can handle it, well, what happens when the trade goes slightly against you? You could be down $1,000 to $2,000 before you know it, and would that make you panic and sell sell, only to watch the trade continue lower? You were right on everything in the trade. You recognized the chart pattern. You entered on confirmation. Your stop loss was accurate. You were completely correct. However, you panicked and bailed too soon because the amount you were down was a little bit too much to stomach. This is why position size is important. You have to be able to stomach the loss so you can give the trade time and room it needs to succeed. Another major mistake, and the leading cause of traders blowing up their account, is that they take a huge position, and when the trade starts to go against them, they can't accept the loss. So they hold and they wait for it to bounce back, but it doesn't. And it continues to go against them, all while they hold and hold and hold, and with each dollar they lose, it becomes harder and harder to sell. Where if they just took a proper position size, it would have been psychologically easier to sell it as soon as it went against you and hold on to that stop loss that you knew was correct to begin with. These are the 4 pieces of information you need to be successful. Spend time studying chart patterns online, or as I recommended, just read the book, Technical Analysis for Dummies. Then follow the next 3 steps as I described. Identify your buy confirmation point, identify your stop loss, and calculate a position size you're comfortable with based on your stop loss. Thank you for joining me, and please don't waste your hard-earned money paying some amateur to explain some magical chart indicators that will make you millions, when your success won't cost you more than some study time or $20 for a book you can find at any Barnes & Noble's bookstore.